I think this is just such a phenomenally great time to be an investor. But I think investors need to take a step back and remember that we have definitively exited 10 years of steady Eddie economic growth and really loose, easy money. And we've been catapulted into this economic environment that I think is driven by two things. One is a much wider range of economic growth outcomes, and the second is tighter financial conditions. We're seeing this in exchange-traded fund flows as investors in their stock allocations are looking to growthier than equities. They're looking to industries, sectors, things that they expect to grow faster than the broad market. And in fixed income, they're trying to find ETFs that provide stability of principal and diversify their sources of interest rate risk.
Martin, where are those? Particularly, it seems like those are very optimal things to have, but what exactly would you invest in? What types of ETFs are characterized by those particular things on the stock side or on the bond side?
In stocks, in looking for stocks and parts of the market that have higher economic growth potential, we see investors favoring things like technology, China, and broad emerging markets. In technology, for example, we look at something like the iShares North American Technology ETF, the ticker's IGM, and what you'd see are FANG and FANG siblings. But there's also the technology leaders of tomorrow, where we see people participating, and that would be something like the iShares Exponential Technologies ETF XT. That's about the technology leaders of tomorrow. That's going to be nanoinformatics. It's going to be big data, cybersecurity, robotics. Those are places where people think there's a economic growth outcome that is going to be growthier, that's going to be better than the broad market.
A lot of interesting options, Martin, but at the same time, I mean, when you take a look at flow data, investors don't seem to want to be in this market right now. I mean, the quarter that BlackRock just reported saw a $3 billion withdrawal of funds, net outflows, and then for the first 3 quarters of the year, flows into all U.S. mutual funds and ETFs were down 46%. So what's going on, and what have you seen in the month of, I mean, October has been a rough one for investors in terms of the volatility. What have you seen more recently?
So I think the context is really important. We've had $350 billion of inflows globally into exchange-traded funds. In the United States, we've had roughly $200 billion. That is nowhere near the levels that we saw in 2017 when we had a near-perfect market for risk assets. But they're organic growth records in organic growth volumes in ETFs that are much better than 2014, 15, 16. We see continued growth in the exchange-traded funds marketplace, but this year where investors are taking pause, where they can find a 3% certificate of deposit yield, they're a little bit slower to move their money into risk assets. And that's really the phenomenon I think you see in ETF flows this year. It's not people taking their money out or not favoring ETFs as a way of building efficient portfolios. It's simply they're taking a pause due to tighter financial conditions and more variable economic growth outcomes.